Good morning. You're watching a remote broadcast of Business World Live. I'm Jes Delos Santos. It's 10:30 a.m. this Friday in Manila. We are about an hour into the last trading day of the week. Let's go first straight to our top story. The Banco Central unexpectedly slashed benchmark rates by 50 basis points to new record low in a bid to ease the economic blow from the COVID-19 pandemic. The cut, the fourth this year, took the overnight reverse repurchase facility to 2.25%, lending to 2.75%, and deposit by 1.75%. This brings cumulative cuts for this year to 175 bips so far. BSP Governor Ben Jokno says the Monetary Board decided to cut rates amid what he described as benign inflation environment to help soften the impact of external risks on Philippine GDP and boost market confidence. Jokno also said that the BSP remains committed to deploying full range of monetary instruments and regulatory relief measures to help the economy get back on its feet. The cut comes after the International Monetary Fund gave a more bleak projection for the economy this year. The lender sees GDP to contract by 3.6%, a reversal of the growth forecast of 0.6% it gave in April. Meanwhile, the inflation outlook for 2020 was raised to 2.3% from 2.2%, with the BSP attributing this mainly to the increase in global oil prices. Union Bank Chief Economist Carlos Asuncion says the BSP's move was preventive rather than reactive, saying it sought to, quote, get ahead of the curve. And after that surprise move by the BSP, let's see how things are faring for the local shares here. You'd see here things not looking well, at least for the last day of the trading week here. The index still down or continuing its 4-day slump here. It is now down by as much as 0.1% at 6,109.93. Earlier in the day, we did see the local bourse managing to make some gains here. In fact, we went up as high as 6177, but then somehow pared back those gains. Again, we are now down by as much as 0.1%. As you can see, this 3-day chart right here. So far in the past 3 days, we are down close to 3% here. According to PNB Securities Manny Lisbona, it's still primarily virus concerns here that's been dampening sentiments for the index, with cases rising in the U.S. That has already reached 2.3 million cases so far, and investors are choosing to cash in on their positions. According to him, should things worsen, expect a downward slope to as low as 5,700 to 5,800. Now, Philstock's Claire Alviar is saying one other major factor here would have to be the IMF's reversal of its growth forecast. You have the IMF now expecting the economy to contract by 3.6% versus its previous growth estimate of 0.6%. That, in fact, exceeds government's estimated decline of as much as 3.4%. Now, one other, at the same time, you have net foreign selling persisting, at least in yesterday's trades, with foreign investors remaining to be sellers with outflows totaling 662 million pesos, however, quite lower than the previous day's outflow. Now, one other major story here, talking about outflows here, you have a record exit of hot money worth $1 billion in May. That is for the third straight month this year. That, in fact, is the biggest yet since 2014. Outflow reached $1.844 billion. That's also higher compared to the $750 million outflow in the same period last year. Also twice as much as the $660 million that exited in April. Now, all in all, that brings year-to-date tally to over $3 billion of net outflow, way higher than the 685 million posted a year ago, according to the central bank. Sentiments really watered down by the ongoing pandemic and its impact on the global economy and the financial standing. Add to that certain events like the U.S.-Iran tensions, as well as ongoing trade negotiation between Beijing and the U.S. And domestically, according to the BSP, one other concern would have to be the review of water concession contracts. Still, top investors remain to be those from the UK, the US, Singapore, and Hong Kong, as well as Luxembourg. And majority of investments entering really the stock market. The rest of that, actually a lion's share, over 80%. The rest entering government securities. In May, majority of foreign investors were in fact net sellers. Question now is how will investors be holding their positions ahead of the weekend? Now, speaking of which, let's have a check at our leaders and laggards. So far, at least on Friday Trader, you'd see Robinson's Retail rather leading the pack here. They are up 3.1% here. There are other stocks here as well. Still, of course, from the JG Group here, you have URC gaining over 2% here at the start of the trade. Evgen likewise still maintaining its good position for the most part of the week here. They are edging higher over 2%. Now, other players, however, on the other end of the spectrum, you have Bloomberry Resorts continuing its decline, slumping by 2.6%. ICTSI likewise here, edging lower at 1.8%. The MCI also sliding by as much as 1.7%. Now, Ayala likewise also in the red, 1.1%. Let's focus on that first because one of their power unit, AC Energy, they have inked a deal for a 720 megawatt renewable facility in Australia. That's for their joint venture with UPC AC Renewables Australia. Now, the thing here is they're going to be linking to Transgrid's 330 kilovolt transmission line in New South Wales. Now, this is expected to bring power to around 250 households yearly. The venture will also allow for the setting up of large-scale lithium-ion battery storage facility. A community fund has already been set up initially with a $100,000 in the first year, increasing by $180,000 yearly. Checking at the movement of AC Energy yesterday, they were down 1.8%. This time around, they are managing to reverse their fortunes. They are up now 0.9%, priced at 2 pesos and 21 centavos a piece. Now off to one conglomerate, Alliance Global. The company is setting its sights on boosting their digital capabilities ahead of the pandemic, and the move really supported by a growth in income in 2019. Now, looking at their performance here, net income was up 15% to 27 billion pesos. Consolidated revenues likewise increasing by as much. That's up 180 billion pesos for the full year of 2019, with all units from Mega World and from AGI rather, the likes of Mega World, Emperador, and Golden Arches posting increase this year, save for Travelers International. This places Alliance Global, according to them, at a good footing amid the pandemic. They are in fact now pushing the move to digitalization with investments made in e-commerce applications, interactive customer service management, and contactless online transactions. They are making those adjustments amid the new reality, as they would like to call it. Yesterday, Alliance Global was down by 2.7%. Still not much of a movement here for the stock, at least at the start of the day's trade. They are still priced at 6 pesos and 86 centavos a piece. Again, let's have a quick check of how the local bourse is performing. Still down here to 6111, down by 0.1%. Now, here are other stories we're watching this morning. The government is seeking to borrow 205 billion pesos from the domestic market in July. The Treasury Bureau says it will borrow 145 billion pesos in T-bills and 60 billion pesos in T-bonds next month. If realized, this will be 21% higher than the country's 170 billion peso program set for both June and May. Auctions for these government securities will be held every week for T-bills, while T-bonds will be offered fortnightly. National Treasurer Rosalia De Leon says they opted to offer longer tenors next month to provide supply in the market. The bond market expanded in the first quarter of 2020, but at a slower rate compared to a year earlier, with both government and corporate bonds posting growth. Peso bonds expanded 8% year on year and 7% quarter on quarter to 7 trillion pesos in the first 3 months. This from year earlier growth rates of 18% year on year and 8% quarter on quarter. But according to the June issue of ADB's Asia Bond Monitor report, the Philippine bond market still posted the second fastest growth across emerging East Asia, behind Vietnam's 9.5% and ahead of China's 4.9%. Now, on to other stories. 14 port projects have been completed this year despite the ongoing health crisis. These include construction of new ports and improvements of existing ones in the country. Among them are the ports in Coron, Palawan, Boac, Marinduque, and Estancia in Iloilo. Some of the completed projects had to be virtually inaugurated due to lockdown restrictions. The Transport Department and the Philippine Ports Authority are pledging to complete 22 more projects by the end of the year. However, that may prove to be costlier for the government. This after the PSA noted that the Construction Materials Retail Price Index, or CMRPI, increased by a full percent year on year last May. That's driven by a faster growth in both carpentry and tinsmithry materials. However, ING Bank Manila Senior Economist Nicky Mapa believes that supply conditions that may have forced prices to tiptoe higher, with imports slowing down due to logistical constraints. Also, the Agriculture Department says its centralized bidding system has helped bring urea fertilizer prices below 1,000 pesos per 50 kilos. Secretary William Dar believes that the downtrend of urea prices proves that the government is on the right track to providing affordable fertilizer to farmers. All procured fertilizer will be distributed to farmers who are participating in the DA's Rice Resiliency Project on a buy-two, take-two basis. La Filipina Uy Gongco and Atlas Fertilizers were awarded contracts to supply almost 2 million bags to parts of Central Luzon and Calabarzon. Meanwhile, bidding for 26 more suppliers is expected to be completed by July 9. Let's circle back to our top story with the central bank making that surprise cut of 50 bips, bringing down rates to record lows. To make sense of that and more developments on the economic front, let's speak to ING Bank Manila Senior Economist Nicky Mapa. Good morning, sir. Great to have you here with us on the show.
Good morning. Thanks for having me back.
All right, it's probably overused by now, sir. I mean, we've been hearing it from since yesterday, but really that action was largely unexpected. We're talking about that rate cut by the BSP. In fact, you have a poll by Business World. You know, only 3 of 13 economists forecasting a rate cut. Your reaction to the BSP's move, was it warranted?
Thank you for the question. Well, I think ING was one of those 3 that had expected the rate cut. However, we were a bit surprised by the magnitude for the rate reduction. I guess this just sort of highlights the possible downturn that we're going to feel in the next couple of quarters, something that BSP is increasingly more cognizant of. And with inflation looking to be at the lower end of the 2 to 4% inflation target, it looked like BSP is carrying out a preemptive strike, throwing in, I guess, everything at this COVID pandemic to try to get and right the economic ship before we fall into a downward spiral that will be very difficult to get out of.
Okay, so it's more of a preventive action rather than a reactive move here from the BSP, at least according to you. Question now is, do we have enough room for more easing for the rest of the year? And shouldn't conventional policy moves be on the table?
Well, I think one of the main reasons why the BSP did this is that monetary policy always operates with a lag. So if you carry out something today, it doesn't immediately take effect. So I think they're going all in. My expectation is that this is their last rate cut for the year. They are moving dangerously close to the inflation forecast. Therefore, real policy rates are increasingly thinning out. So I think they'd like to preserve positive real policy rates. And this is one of the main reasons why they sort of shifted tone, indicating that although they are retaining their accommodative stance, the possible next move may be a reduction in reserve requirements should liquidity conditions warrant further easing from the BSP. On unconventional moves, I think Deputy Governor Dakila sort of hinting that we'd like to stick to our conventional policies for now, given that they still have space technically on both Triple R as well as your policy rates. So for now, I think unconventional policy will not be explored just yet. They do have a little more space to do some easing. However, I'd like to highlight that all of these measures that the BSP has done, they remain to be lending measures. And what we may need in the future or sometime very soon is spending measures from the other side of the government fence.
And what exactly spending measures do you think should be in the offing, at least in the near term?
Well, the fiscal policy has delivered quite a substantial response. However, I think given the magnitude of economic downturn that we're experiencing right now, unemployment at 17.7% and likely to get worse, we will need a substantial fiscal response, something that's pending in Congress right now, something in the tune of 600 billion or more to address this the economic downturn from COVID.
Mm-hmm. And at the same time, you were talking about the RRRs earlier. Do you think they're considering that the BSP Governor Ben Jokna still has some space to actually make some cuts in that front? Do you see this happening in the near future?
Given current conditions, I am not seeing a reduction in reserve requirements just yet. Currently, there is 1.3 trillion pesos in excess liquidity sloshing back between the BSP and the banks. So it looks like there's a lot of liquidity out there, and I think the BSP, by cutting policy rates, I think they highlighted that rate cuts will make borrowing more affordable and should sort of convince consumers to spend a bit more or businesses to get back online. So cutting rates and the working together with the abundant liquidity out there provides the fertile backdrop for a recovery. However, these are just once again the groundwork for recovery. We're going to need some fiscal impetus to get that off the ground.
Mm-hmm. At the same time, like what you did mention earlier, the BSP anchored really its latest move as well on inflation expectations. In fact, hiking it to 2.2%. Do you see? How do you see inflation coming in, at least for the month of June and then and the months that will follow? Do you still expect it to be remaining in that benign territory?
Yes, I think Governor Jokna himself said that inflation may trend a little lower, falling right below 2% for the next few months. June inflation likely at 2% or lower, mainly because you have such a depressed economic environment. Commodity prices, although bouncing from their lows in April, still quite low, even compared to last year. So it looks like we're going to see this environment of low inflation for some time. One reason why the BSP thought it was a good move to cut policy rates yesterday by that hefty 50 basis points.
Mm-hmm. Now, in terms of fiscal response, we were talking about this earlier. Do we still have enough room or actually enough capabilities to actually accept more loans or at least get more loans, with loans already totaling $5.7 billion as we speak?
Well, I think the government has right now, they should have the wherewithal to spend to get the economy back on its feet. With consumption and households largely, I guess, crippled or hampered by all of the job losses that we're seeing, there is no other sector out there that can spend with this this type of power that we need to get the economy back on track. So government they borrowed quite a lot in the international markets. They have a bevy of liquidity, peso liquidity onshore. So if they need to spend, I think they can easily raise the funding for that. The bigger question is, are they willing to spend, and how much they're willing to spend to get this economy back on track?
Mm-hmm. Well, apart from that as well, you have authorities now looking into deepening its tax fold by taxing digital and online players. What's your take on this? Will this really, do you think, beef up at least the government's COVID response war chest?
Well, I guess you can always look at it as two sides of the issue here. You may be taxing to improve your COVID war chest. However, at the same time, you're also going to be hurting consumption. At a
Mhm.
time where consumption is so fragile, economic outlook is so bleak, maybe not the right time to be slapping taxes. I think that the opposite should be true. We should be actually lowering taxes to help encourage spending and investment. Maybe they can raise it in other avenues or other ways to raise the funding. And as we mentioned earlier, there's 5 billion plus US dollars worth of foreign borrowings onshore. You also have 1.3 trillion pesos in liquidity just sitting there. And with bond yields looking the way they look now, it might be a good time to tap the market to get funding for COVID instead of
Mhm.
taxing the consumer.
But at the same time, you have restrictions already being eased. Do you expect at least tax revenues to somehow recover in the coming months or in the coming periods?
Yes, and this is something that I guess the government should focus on. And if you get the economy going, you also increase your revenue base. The main reason why you're running such a heavy deficit is because there's absolutely no consumption or very limited consumption going on. Therefore, your tax take was down. But as the economy recovers, as we try to operate in this new economy with COVID, if we play our cards right, then the economy comes back to life. Then we'll see the revenue streams start to pick up again, and we won't be worried so much about the falling revenues anymore. So get the economy back on its feet, even if you have to spend a little more to get the economy humming again. And then once it's up at I guess back to normal speed, then revenues will follow.
Mhm. And at the same time, on the global front here, you have world economies already easing restrictions here. How should this temper declines in exports and imports, or do we expect improvements to remain gradual? How soon do we expect trade to recover?
Well, I'm not very optimistic on the trade front. We can see how like in the big example is the United States, how select southern states in the Sun Belt are now
Mhm.
thinking about reimposing or reinstating lockdown measures because COVID cases are spiking. So I guess this is I guess fair warning to a lot of governments out there that the disease, the virus is still out there, and we really have to rethink it how we navigate this new economy with the virus until we get that vaccine out. So maybe trade recovers from its lows, but I think I echo the sentiment of Fed Chair Powell. It's going to bounce, but it's going to stay subdued for quite a long, protracted period of time until we get that vaccine. But until that time, we're going to have to learn how to play this game, economic recovery in a time of COVID.
And do you think that will be pretty much the case as well when it comes to hot money here? Of course, we did post a record outflow in May, hitting $1 billion. Do we expect a boost in investor sentiment in the future?
I think the large outflow seen in May was tagged to the I think it was like 30 or 40 straight sessions of net foreign
Hmm.
selling in the PSE. That's sort of come back a bit. I think over the past month in June, although sort of consolidating now right now with the sort of semi risk off tone that we're seeing. So I think there may be some room to run, especially if we find a way to better navigate this COVID 19 environment, we are slowly operating or opening back up. But I think the health officials are always going to say just make sure you take those precautions. Government must also always be cognizant that the infection is still out there. So trying to operate in an environment I understand is very tricky.
Hmm.
But I think we're definitely going to need some extra stimulus to get the economy back online, especially in this time of COVID.
Okay, now when it comes to budget gap here, that hit 202 billion pesos in May. This as government continues to ramp up spending as part of its COVID response, amid, of course, a continuous slump in revenues. How might this be narrowed in the future? Or do you see this just widening even further?
Well, for sure. I mean, one of the main reasons why we saw the revenue sort of below to 200 plus billion is because, the budget deficit. Your revenue streams are falling out. However, I think the better metric that the government should be watching is your deficit to GDP ratio. And there's
Hmm.
just two sides to this equation. You have your deficit and your growth. So what's important is that you spend and you spend quickly and you spend, I'd say, to the right sectors so that you can grow your base, your economy, your GDP number faster than you're piling up debt. And when you have a scenario where you're spending quickly and well and targeted, you can grow your GDP numbers much faster than your deficit is swelling. Then you have a lower deficit to GDP number. I
Mhm.
think year to date, our deficit to GDP ratio is 3%, still a ways from the 9% threshold that the DOF is talking about. So I think there's a lot of room to spend. And if you spend early and you spend well, and the economy is back on its feet, you get the revenue streams back online, therefore mitigating some of that pressure on your deficit.
And the government has, talking about spending, the government has been banking so much on infrastructure spending here. Did you see things catching up with at least some forms of easing already being put in place?
Well, I think I agree with the government that infrastructure will be, I guess, adding fuel to this recovery. It employs a good number of our labor force, and it gets, I guess, the overall construction side will benefit, as well as the sectors that are linked to construction supply. So, if we get that going, if they can find a way to operate, limit infection, even at the time where you have construction going on, that will be key, both in the short term and the long term or the medium term, as we improve our infrastructure so that once we get out of this lockdown or finally beat the virus, we'll have better infrastructure for it. So I think it's a good move. However, I think we're still going to have to make sure we have all those health checks in place.
All right, and then lastly, you now have the IMF already reversing track, seeing contraction of as much as 3.6% for the Philippines, even exceeding government projections here. What growth path do you see for the economy?
Well, initially I was very optimistic and expecting a V-shaped recovery. However, I think we're gonna, way things are going, it looks like we're in for the long haul. So maybe a U-shaped recovery. And I'd like to say that the shape or the length of that U will pretty much depend on how quickly we can get back to normal. And I guess the answer to that is how quickly the fiscal response, the rescue bill can get out there, and what type of rescue bill we're expecting. Will it be sizable? Will it be targeted? So we need to get that out, I think, at the soonest to right the economic ship. And I'd say forecasts this year, looking at a negative 5.8 for the second quarter and another contraction in the third quarter, where we will be in full-on recession by then. So hopefully we can get that spending out as soon as we can. So monetary policy's done a good job, brought out a lot of it's done its part. It's now waiting on its partner, the fiscal sector, to bring on goods.
All right. Thank you very much for your insights, ING Bank Manila's Nicky Mapa. Thank you so much for your time, sir.
Okay, take care, stay safe.
Okay, let's have a quick check of how things are happening in the local shares here. Things not looking good as we end the week here. You can see here the index still slumping by 0.1% at 6111.99 here. Again, in the past 3 days, local shares have been slumping by close to 3% already. This, of course, as COVID-19 virus fears continue to spread with cases rising domestically and globally. The U.S., of course, posting more than 2 million cases already. And domestically, just a few days ago, we did manage to a record or post the highest a record, a single day increase of over 1,100 cases here. Now, let's have a quick check as well of our leaders and laggards. Let me just refresh this rather very quickly. You'd see here, Globe is now leading the pack, up 2 7/10%. Metro Pacific likewise, also surging by as much as 2 2/10%. But there's one stock here that I really want to focus on, JG Summit. As you can see here, the stock is now up 0.8%. And one considerable development here, at least on the stock, is that they are saying that they own 61% of Altus Property Ventures. Now, it's very interesting to take a look at Altus here because they have just listed on the Small and Medium Enterprises Board of the PSEI this morning. Listing price was at 10 pesos and 10 centavos a piece. But looking at the price of Altus here, they managed to jump as much as 40 pesos earlier in the day. In fact, looking at this chart as well, you'd see here, they were even priced here as much as 200 pesos here. So the stock had to go on a circuit breaker halt on its first trading day, after increasing by as much as 1,187%. However, they managed to at least pare back those gains here. The stock is now priced at 92 pesos a piece, increasing by over 137% so far. Again, going back to what JG Summit was saying, they own 61% of Altus Property Ventures. That's due to the fact that you have RLC saying that a property dividend consisting of up to 100 million common shares of Altus Property JG Summit as a shareholder of RLC was entitled to receive over 60 million APVI shares as property dividend. Again, Altus listing on the SME board of the PSEI, now priced at 93 pesos and 50 centavos a piece. Again, that pretty much is in contrast to how the rest of the local bourse is performing, as it still remains to be edging lower 0.1% to 6,111.48. And that's our first look into the business day this Friday, June 26, 2020. Catch again Monday next week at 10:30 a.m. I'm Jes Delos Santos, VR1 News.